Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her website, jugglingdynamite.com. Welcome back to the show, Danielle.
Hi, Jim.
Danielle, it looks like Canadians are up to their necks in debt, maybe up to their eyeballs. With interest rates now frozen, perhaps even dropping, is that just another case of rebaiting the debt trap?
Well, yes, it could be, but there's a few things that have fundamentally changed in the last 6 months in particular, and say over the last year. I mean, you know, yes, it's not good, Jim, to be world famous for being debt gorgers and to have a household debt to gross domestic product of 100% now, as we do in Canada. That makes us well ahead of Italy, Germany, Japan, France, U.S., U.K. All have lower debt to household debt to GDP levels. So we're world class, and that's not a good thing. But the thing is that we have been saying, because we've been watching the debt levels for the past few years, we've been saying that the Bank of Canada was dreaming when it thought it could hike rates as much as it was telegraphing over the past couple of years, and we felt that it was going to choke off demand in the system. And of course, that's happened all over the world, and you've had a dramatic downturn in growth forecasts from every major organization. World growth now is expected to be maybe 3.5 over the next couple of years, and that's a significant downtrend from what that we were forecasting even a couple of years ago. And really, it's just this debt saturation theme, right? Everyone has got so much in the way of payments that they're trying to service, and they did start hiking rates, as we know, between December of 15 and December of 16. There was incremental 0.25 rate hikes all around the world, certainly in the U.S. and Canada, and that was quite a shock to the carrying charges of people who were just sort of barely getting by. And what that is, you know, that combined with a bunch of factors in the world and the peak of the cycle and all the mergers and acquisitions and all the things that have gone on have really just set us up for this slow growth period, which of course when revenues come down, it makes it difficult for companies to maintain profit margins and then eventually to cover their expenditures, and they start looking for ways to cut costs, and one of the ways they do that is to lay people off. And we've seen that bounce now in the unemployment rate off the bottom of this cycle. So as the unemployment rate moves back up again, you get this crunching, cash crunch that's hitting. And in Canada, we're very vulnerable this time. So the trustees in bankruptcy keep talking about the record volumes that are coming through their door every week of people who've just said, oh my goodness, I've been trying to keep this up for the last, year or so, and I've been borrowing from one loan to another, and I've got myself a bunch of these high-priced, payday loan scenarios, and it's just hopeless. They can't get out of it. So the funny thing is now, not in a comical way, but the funny thing is that the interest rates have come, the yield curve is inverted now in Canada and the U.S., which means that short-term rates are higher than long-term rates, like 10-year rates. And what that means is that banks are now getting crunched as well, because if you remember, banks borrow our deposits and pay us a short-term interest rate. They borrow from the Bank of Canada and pay a short-term interest rate, and they loan it for longer terms. And the difference between that is the spread. So in a normal positive sloping yield curve, they pay a lower rate and loan out at a higher rate. In an inverted curve, they are now able to they have to pay more to deposit holders in the Bank of Canada than they get to loan it out at. And ultimately, That means they're not making profits on loans, which means they pull in their lending. So just as mortgage rates have come down in Canada in the last little bit, as the 5-year the 5-year bond rate comes down, that's what our mortgages are linked to. So our 5-year mortgage rate is now about 3.49%, but it's been there since November, pretty much. And the 5-year bond rate is at 1.44 versus 2.47 where it was in October. So we've lost 1% off the 5-year bond rate in the last 6 months. Mortgage rates have pretty much stayed flat, but even if they were to come off a bit here, people are going to have a hard time refinancing for a bunch of reasons. One of them being, higher mortgage rates that are required if they're going to go to other institutions in terms of the tests that we've brought in, the higher rate tests. But also because banks are just less inclined to lend in this environment. It's not very profitable for them. And so there you've got the makings of a credit crunch where revenues are falling, unemployment starts to rise, debt service charges are off the charts, and people just sort of start going to bankruptcy and other means to work around their debts, and defaults rise. So normally mortgages are the last to go, and you see that right now. Defaults in mortgages are still really low in Canada, but you're starting to see defaults in other types of revolving credit, and that's sort of the tipping point when you normally see in a cycle that will, get worse from there.
Does it hurt as well when you have a federal government running up massive deficits after they promised in their election campaign that we would have a balanced budget by now?
Well, you see, this is the conundrum all over the world. This is the people who talk about using deficit spending to stimulate the economy, and they never do the pay down during the growth phase, right? That was the part of the equation that was lost, was left out of it. So, the whole idea was, yes, maybe governments could run deficits during recessions in order to support the economy, but during the boom time they were supposed to pay down the debt, and we've done it exactly the opposite. On every level, in this extended boom that central banks have largely manufactured through their various, different gimmicks, record low rates and QE and all this stuff they've been doing for the last few years to keep this cycle sort of plodding along. What's happened is they have encouraged people to take on more debt, not to pay it down. And this makes us particularly unprepared for the downturn as it comes in. And this is the same for corporations. You would think if you've had we've had a decade-long boom in corporate profits where they've had record growth rates, right? And they peaked in 2018, and you might think, well, they've had such a great run, they would have, stocked up their balance sheet with tons of cash, and they would be in great shape so that if they come into the slowdown, they won't have to cut a lot of costs, they won't have to lay a lot of people off, surely they're in good shape. The answer is, that's not what happened, right? What happened is corporate debt levels are now at cycle highs, and lenders are already feeling alarmed, just looking at the fact that revenues have been falling, and that means that, there's less cash flow to service all this record debt. So even though rates may go a little lower, there's not a lot lower for them to go because we never got to normal rates this cycle, thanks to all this suppressing of everything for so long. And so everyone is really being taken off guard, and that's really ludicrous when you think of it, because as I say, you had this extra long expansion, longer than average by a lot, and you'd think that during that period people could have used low rates to pay down debt, corporations could have built up cash, but instead they went into a merger frenzy, acquisition, paying each other out with inflated shares, borrowing to do that, buybacks, all this crazy stuff, and so everybody is less prepared going into this downturn than they have been in some time.
We'll have more with Danielle Park right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, what's your feeling on people looking at government bonds as a safety net?
Well, there's no silver bullet where there's no risk and there's only upside in any asset class in the world. Let's start with that. But generally speaking, what happens in these cycles is that people realize that, there's a lot of risk on the corporate balance sheet side, on the corporate debt and the equities. When they do things like plunge the way they did in the last quarter of 2018 and wipe off trillions of, paper wealth in a matter of a few months, and people say, wow, that was a shock. That was a wealth shock that many were not expecting. And you start to see them look for, where can I go where I won't have to go through sleepless nights and all this upset. And they start going back to things that are more guaranteed. So guaranteed as in highly liquid, principal, it has to be returned at the maturity date, and there's a stated contractual payment of interest that's required. And that is government bonds. People tend to, lump bonds all in one pot, and that's not fair at all, because corporate debt is bonds issued by companies is a highly different risk profile. Companies can have all different types of financial profiles and strength about them, but as I say, because of the business cycle, they can be, looking really strong at one moment, and 6 months later, if they haven't managed it well, they can start to look really precarious. And the bond market will quickly reprice risk when it looks like it's when risk looks really underpriced, when assets are very high. They tend to sell off fast, and people go back to things where they have more stability. So North American government bonds, I've mentioned this before, particularly in Canada and the United States right now, they have a major yield pickup over European and Japanese bonds, which are currently negative yielding all the way out to 10 years. Again, this goes back to the central bank manipulation and QE buying that's really forced the yields down so far on the, quote, safer assets as a ploy to get people into the market casino that they want, so that, all the companies can continue to do their buybacks and play the casino. So really people they've been trying to shake people out of these government bonds, and it hasn't worked, because at some point the other alternatives get so awful, the risk looks so large, that people are saying to themselves, institutions will say, well, I need to park capital somewhere where it's liquid, I'm able to quickly convert to cash, and I'm not likely to lose a lot of it. So when they look at a government-issued debt, they say, well, governments can always increase taxes, and they have the most flexibility in terms of raising funds. So they will stay in those instruments even though they're negative yielding, as I say, in some cases. So when you look at the North American yield curve, even though bond, in the fall, we were able to get government bond yields around 3%, and even GIC rates were up around 3%. In the last few months, they've come off dramatically, but they're still yielding significantly more than zero, and certainly a lot more than a negative yield, which is what capital has to pick from, as I say, overseas. So the things that are unique about government bonds in this environment is, as I say, they go up in value typically, because if you're holding them before the pack starts moving into them, the pack starts driving up the price as they take a flight to safety. So you tend to get a capital gain on top of this prescribed interest payment that comes in every 6 months, and you also have security of principal. So it's one of the few places that doesn't tend to sell off when everything else is in a bear market. And I think that since the fall, this bear market has begun, and you're going to see further downside risk in all the corporate stuff even in the commodity sector, you tend to see a sell-off, a positive correlation with the business cycle here. And government bonds are one of those rare shelters. Now, I'm not saying every government bond. I'm not saying that you should be exposing yourself to foreign currencies in trying to buy their bonds, but I'm saying in your home currency, in governments like Canada, this is a place for people to make some capital gain, secure their principal, earn some interest income, and wait for the repricing to happen in these other assets, at which point you can then step in and pick them up at much lower prices.
What about tax-free savings accounts? Is that a good place to put your money? Some paid pretty decent interest.
Well, this kind of question is quite typical, and it's basically just like an RSP is just an umbrella, and underneath that umbrella you can put any kind of security. The same is true for a TFSA account. It's simply the type of account. Inside that account you can hold pretty much anything from equities, ETFs, bonds, or GICs at your bank. So yes, it is fine to have a tax-sheltered account. It is a good idea for most people, because if you're going to be earning income on long-term savings, you might as well not pay tax on it while you go. To the extent you have these shelters available, it makes sense to open them and to put the funds in them. But that doesn't mean, as I say, that you have to go buy yourself, Bitcoin in them or some very high-risk security. You can certainly buy, as I say, government bonds in there. You can put them into high-interest savings and make like 1.8% or so, keeping it safe, keeping it liquid, and then while you're earning that income inside that account structure, you're not going to be having to pay tax on it as you go.
We'll have more with Danielle Park right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, in Vancouver, a small airline, Harbour Air, which operates seaplanes on short-haul routes, is experimenting now with electric aircraft. They'll start with one. Is this the wave of the future for short-haul airlines?
Well, it seems to be. I mean, I've been on that airline. They're very well run, and it's their business, and they're saying they can see a way to making this profitable for them, and I think it's excellent. I mean, who wouldn't want to have a silent, clean plane to come in and out of those beautiful islands in that part of the world? You know, you don't have the risk of crash and fire, you don't have the pollution into the water, and you don't have the pollution into the air. And surely there's nothing bad about any of that. You want to have as clean and pristine as environment as you can in that part. So I think it's very encouraging. I thought it was great to see.
Well, one of the biggest costs for an airline is the price of fuel. That would certainly come down.
Absolutely. And, everyone talks about, every time we have this conversation, I get a bunch of emails from people saying, if they're plugging it to conventional resources in the grid, then it's not cleaner but it is cleaner because it's not doing it on site. It's a much more efficient, power source than burning fossil fuels in small engines and having to refill and buying them on market rates. And the grid is becoming more green as we go, and that will continue. And that means that every time you're charging, you'll be getting a higher ratio of clean energy in the grid. So it is definitely a very positive development.
One of the reasons some have given me for slow auto sales right now is so many people have told me they plan to have the next car they buy be electric, so they're waiting for the prices of electric cars to come down. But I would think until people start buying them in large numbers, the number or the price won't come down.
Well, that's exactly the trend you'll notice when you look at the actual sales data right now. all the major car companies are in a major sales downturn. This is for China, this is for North America, Europe, everywhere. And the only type of vehicles which are selling out and surprising to the upside are the EV lines. So they're all scampering to bring out their EVs, the BMWs, the M-Class, the Mercedes, all that. Every time they announce an EV version of one of their standard vehicles or one of their lineup, it's sold out before they even get it out the door. So they should be getting an indicator from this that there's a lot of public interest in electric vehicles. And indeed in China even, that was the case. I noticed that the data there is that the EVs are on back order and the other kind of cars are just sort of languishing in terms of the sales. So, I think consumers definitely want electric vehicles. They want it for the very selfish reason that there's a fraction of the parts, a fraction of the maintenance costs, a fraction of the fuel costs. I mean, what person wouldn't want this when it's an excellent vehicle? You get the same body, you can buy it from your favorite brand, same everything except a lot less cost for you. The Tesla Loop in California has something like 400,000 miles now of data because they've been running this Tesla Loop, which is this, you can get it in LA and take it to Palm Springs or all over California. It's like a shared vehicle that will pick you up and take you with other people from A to B, and you pay a price per route. And they just released all their data just in the last couple of days showing that they've put, something like 500,000 miles on one of their Model S or Model X that they're using for this service, and that the repair costs were $9,000 in total for all these miles. And relative to, a Mercedes or another vehicle of similar quality, it would be 10 times that. So there's just so much upside, and when you've got consumers that are cash strapped, as we know people are, and it's likely to get more cash strapped as incomes take a hit and revenues fall in the next little bit, obviously every way that we can cut costs is going to be an enormous help. So definitely electric vehicles have an upside. Now, it's going to be difficult for consumers to afford them when they're already carrying tons of debt. But why would they take on another type of car loan or car lease at this point if they know that a cheaper option or a more cost-effective to run option for them is in the pipeline and that they can probably access that in the next year or two? So I think absolutely that the inventory that is sitting around, if you notice, of regular ICE engines is just massive. They are parked left and right. And we are now, after the debt bubble, after the debt bust, which is happening right now, demand is going to be, as we say, looking for more efficient options, whether that's foregoing buying altogether and going for shared riding programs and, the various ways people can get around without having to buy a car, or whether when they do go to buy a car, they look for one that's cheap to operate, and that's definitely going to be the EV lines.
Sure. And then if you live in a place like Vancouver, where we have the highest gasoline prices in North America, $1.62 a liter is not impossible some days. Paying 75 cents a day for an electric car to fuel it looks pretty attractive.
Absolutely. It's just math. And also, it's about air quality. Many big cities suffer from very bad air quality, and people that try and do things like, bike and walk, the asthma is up, the asthma incidence is very high. The number of people dying every year from airborne or air pollution related illnesses is rising. So I think people definitely see this as an intelligent solution. This coupled with things like 3D printing, which are, taking out a bunch of middlemen and steps and doing more on-site production. I think this is going to be a massive theme for this next decade, where instead of making things cheap in another country and shipping them and having to have fuel costs and pollution created by shipping them, people are using constituent parts on site to create things from scratch. And I think this is another area where Canada, as we try and pivot away from our dependence on the fossil fuel industry, as we look forward, one of the most intelligent things we could do is figure out how to be a niche or a specialized producer of things. So one of the areas that we surely must have an advantage is in the area of 3D printing, because we do have a resource-rich country and we have many of the constituent elements at our disposal or in our country that people use for this 3D printing, whether it be for manufacturing, whether it be for healthcare, vehicles, all sorts of things. So I think this is going to help bring jobs back to North America. The whole globalization push, which put all the jobs in cheap areas and, flatlined household incomes in this part of the country over the last couple of decades. This is an opportunity for us to go back to more local production and putting, I think that the trade dispute stuff is going to be ongoing, and it's going to be less palatable or likely that companies are going to want to make big investments in manufacturing in foreign places like China. And this is just coming at the exact time when you have things like 3D printing that makes it more possible that we can do things in our home country. So I think this is another big theme, and it's all about, after the debt rush, I like to say, we had this decade or two of just inflating debt beyond recognition, and now we've all got the weight of that payments, and we've got that at a time when the population is aging, and we've also got a housing problem because most of the houses are overvalued and can't be bought by the people behind them. So we've got a lot of weight on this economy. The way out of this is not to add more debt, right? We cannot keep adding debt and emaciating households further and expect that to get us to a better result. The way out of this is to actually just focus on how we can increase efficiency and how, and like I say, luckily technology is coming to the rescue about the time when we desperately need to make some big changes as these debt models break apart.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You can find her website, jugglingdynamite.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have questions for Danielle or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.